Welcome to Stock Talk, everyone.
Good to be here.
We're diving straight into Honda Motor Co. Ltd's fiscal year 2025 results. That's ticker HMC. They just came out today, May 13th, 2025.
Fresh off the press.
Exactly. And hey, if you find this deep dive useful, please give us a like, subscribe for more analysis like this, and maybe share it with someone you think might be interested.
Always appreciated.
So today, we're going to unpack these results. We'll look at how revenue went up, even though profits, well, they slid down. We'll pinpoint what's driving things. Motorcycles seem really strong, but the car side facing some issues.
Definitely a mixed picture there.
And then we'll look ahead to their forecast for the next year. Tariffs look like they're going to be a major factor.
A really big factor, yeah.
So stick with us, and you'll get a clear, pretty thorough understanding of what's quite a complex set of results.
Right. So looking at the top line for FY25, Honda's numbers, well, they do tell a bit of a story.
How so?
We see that sales revenue jumped up 6.2%, hitting 21.69 trillion, which sounds good, right?
Yeah, solid growth.
But when you peel back the layers, you see a lot of that growth came from two main things. Their motorcycle business doing really well, and favorable currency exchange effects.
The currency tailwind.
Exactly. It kind of highlights how much their global footprint matters and, well, where the momentum is right now.
Okay, absolutely. That motorcycle business, as you said, seems to be really humming along. But then you look at operating profit, and it's a different picture. Down 12.2% to 1.21 trillion.
That's right. A noticeable drop.
What really pulled that down?
Well, the report points to a couple of main pressures. First, they deliberately spent more on R&D, research and development.
Investing for the future, presumably. EVs, autonomous driving, that sort of thing.
Precisely. It hurts profit now, but it's a clear bet on where things are headed. But second, and this is a big one, there was a one-off adjustment. 127.6 billion.
Just vanished.
Well, not vanished, but it was a negative hit because they changed how they estimate future warranty costs for their cars.
Wow, 127.6 billion just from changing an estimation model.
Yeah, it's a significant accounting change. It suggests they're taking a, let's say, more cautious view on potential repair costs down the road.
That really does signal something about potential future costs in the auto division, doesn't it?
Yeah.
And that profit squeeze wasn't just at the operating level, right? The bottom line, profit attributable to the parent company, that fell even harder.
It did, yeah. That figure was down quite substantially, 24.5%, landing at 835.8 billion.
Ouch.
And if you connect that to their wider global operations, part of that drop came from lower earnings from their investments in Asia. They account for those using the equity method.
Right, where they own a chunk but don't have full control.
Exactly. So, how well their partners are doing and the general economic conditions in those regions, that also feeds into Honda's final profit number.
So, okay, top line's growing, but profits feeling the pressure pretty much across the board. We saw profit before tax down, earnings per share down too, and operating cash flow. That took a big hit as well.
Indeed it did. Operating cash flow decreased quite a bit. The report says it's mainly because they paid out more cash for parts, raw materials, and also for leasing equipment.
So higher operational costs eating into cash.
Basically, yeah. It raises some questions about, how efficiently they're managing costs and their short-term cash right now. On the flip side, their total assets did actually grow.
Right, assets up. And we should probably mention that stock split they did back in late 2023. That changes the per-share numbers, doesn't it?
Oh, absolutely. Good point. That 3-for-1 split is crucial context. You have to factor that in when you're comparing earnings per share or any per-share metric year over year.
It means there are 3 times the shares out there now.
Exactly. So the per-share figures look lower partly because of that split. You need to adjust for it mentally or, look at the adjusted figures if provided.
Okay, let's zoom in a bit now. Performance by business segment. We keep mentioning motorcycles being strong. Just how strong were they?
They were really the star of the show in FY25. Revenue shot up 12.6%. Profit, even better, surged 19.3%.
Wow.
And here's the kicker. Motorcycles are only about, 17% of Honda's total revenue?
Right.
But they generated over more than 50% of the total profit from all the segments combined.
Over half the profit from less than a fifth of the revenue. That's incredible profitability.
It really is. It highlights, maybe strong demand in places like Asia, perhaps better margins than, say, cars, especially with all the EV transition costs.
Okay, a stark contrast indeed. Because then we look at the automobile business.
Yeah.
Makes up most of the revenue, as you said, but the profit story. Very different.
Very different is right. Autos bring in almost 67% of the revenue, the vast majority, but profit just plummeted, down 56.5%.
56.5%. That's huge.
It is. And that big 127.6 billion warranty estimation change we talked about, that hit the auto segment directly. Plus, you add in the increased R&D spending, a lot of which is focused on future cars.
It hammered their auto profitability.
Exactly. It really paints a picture of, well, the intense competition and cost pressures in the car industry right now, especially during this tech transition.
Makes sense. What about their financial services division? Sometimes that's a steady earner for automakers.
It certainly was for Honda this year. Financial services showed really solid, steady growth. Revenue up 8.0%, profit at a healthy 15.2%.
Nice.
Yeah, this part of the business, car loans, leasing, that kind of thing, it's definitely becoming a more important contributor. Provides a nice, stable income stream.
Good to have that balance.
Huh.
And lastly, there's power products and other businesses. How did that do?
That segment faced a bit of a headwind. Revenue dipped slightly, and it actually posted an operating loss again.
So not contributing positively to the bottom line.
No. This includes things like, generators, lawnmowers, marine engines. It suggests Honda might need to perhaps reassess their strategy there, look for improvements, or maybe even streamline things a bit.
So yeah, a really mixed bag across the different parts of the business. Strong motorcycles, steady finance, but real pressure on cars and some weakness in power products.
That sums it up well.
Okay, let's shift from the income statement to the balance sheet and cash flow. How's their overall financial health looking?
Well, as we mentioned, total assets went up, but interestingly, total equity, basically the shareholders' stake in the company actually went down.
Why was that?
Mainly because Honda was actively buying back its own shares and paying out dividends. Both actions reduce equity.
Returning cash to shareholders.
Exactly. And operating cash flow, as we touched on, was down significantly. Again, mostly due to paying out more cash for running the business day to day.
And were they investing heavily? What did the investing cash flow look like?
Yes, investing activities showed a cash outflow. They spent more on capital expenditures, things like factories, equipment.
Building for the future again.
Seems so. And they also acquired some financial assets, so definitely putting money to work. Financing activities, meanwhile, showed a cash inflow, but it was much smaller than the year before.
Why smaller?
Because those share buybacks and dividend payments we mentioned are financing outflows, partially offsetting any inflows from, say, issuing debt.
Okay, so cash levels overall probably took a bit of a dip then.
They did, yeah. Cash and cash equivalents decreased by the end of the year. But it's important to stress, they still have a very healthy amount of cash on hand.
So still a strong liquidity position. They're not strapped for cash.
Not at all. Plenty of financial flexibility. And it's worth highlighting again that increase in capital spending CapEx was seen across all their business segments. That signals broad-based investment.
Right. And they did return a lot to shareholders, didn't they?
They did. Dividends and share repurchases combined came to over $1 trillion. Significant shareholder returns.
All this spending, especially on R&D and CapEx, points towards their strategy. Let's dig into that a bit more. R&D and strategic initiatives.
Right. The R&D spend was up a hefty 19%. That's $1.10 trillion, representing about 5.1% of their total sales revenue.
Which is a pretty significant ratio. Where's that money going?
The focus is clear. Electrification is huge, obviously. Autonomous driving technologies, connected services linking the car to the digital world. But they're also still investing in their traditional strengths, like motorcycle innovation and safety technologies.
Covers all the key bases for future mobility, really.
Yeah.
What about broader strategic moves beyond just R&D funding?
They mentioned establishing a new division called Quality Innovation Operations.
Sounds like a response to those warranty cost concerns.
It seems very likely, yeah. Aimed at improving product quality and managing those costs better. They also talked about general cost management efforts, smart capital allocation, including the shareholder returns we discussed, optimizing their manufacturing plants globally, and trying to leverage the diversification they have across their segments.
Try and make all the pieces work together better.
Essentially. And they reiterated that the big warranty estimation change, while painful in FY25, should lead to more accurate cost planning and better financial management in the long run.
So, looking to improve efficiency and control alongside the future tech investments. Okay, let's pivot to the outlook. FY26, the current fiscal year. You said earlier the projections looked cautious.
That's putting it mildly, perhaps. Yeah, their forecast for FY26 anticipates decreases across the board. Sales revenue, operating profit, profit before tax, and the final net profit attributable to owners, all projected to go down.
Down across the board. Did they say why? What are the big headwinds?
Oh, yes, they're very specific. Two massive factors stand out. First, tariffs. They're projecting a negative impact of 450.0 billion just from tariffs.
Wow, nearly ½ trillion yen.
It's huge. And second, foreign currency fluctuations. Based on their assumed exchange rate, 135 to the US dollar, they expect another negative hit of 452.0 billion.
Good grief. So just those two external factors wipe out around 900 billion from their
Yep.
projections.
Pretty much. It's
Yeah.
a massive headwind. On top of that, they also expect R&D expenses to rise further by about 126.0 billion and other operating expenses to go up too.
So tariffs, currency, more R&D spending, higher operating costs. Sounds pretty bleak. Are there any positives expected to offset some of this?
There are a few potential bright spots, yes. They expect some positive impact from just selling more stuff, a volume increase. They also anticipate some benefit from their pricing actions and ongoing cost-cutting efforts.
Okay.
And crucially, that big one-time negative warranty adjustment from FY25 won't repeat in FY26. That alone adds back 127.6 billion compared to last year's result.
Right, that helps. But it sounds like those positives aren't nearly enough to overcome the massive negatives from tariffs and currency.
According to their forecast, no. The net result is projected to be significantly lower profit.
And yet, despite forecasting lower profits, they're planning to increase the dividend.
That's right. They plan to raise the annual dividend to 70 per share. It's a pretty strong signal of their commitment to shareholders, even when profits are expected to fall.
That implies a very high payout ratio, though, doesn't it? Paying out a large chunk of expected earnings.
It certainly does. It underscores how focused they are on shareholder returns, perhaps betting on a recovery beyond FY26, or just prioritizing it even in a tougher year.
Okay, let's try to wrap this up then. FY25 saw Honda grow revenue, thanks mainly to motorcycles and currency, but profits fell significantly, dragged down by that big warranty estimate change and higher R&D. Big differences between segments.
That's a fair summary.
And looking ahead to FY26, it looks challenging. Tariffs and currency are poised to inflict major damage on the numbers, outweighing expected gains from sales and cost control, even though that warranty hit won't repeat.
Yeah, the outlook is definitely dominated by those external macroeconomic factors alongside continued investment needs.
So if you had to list the key opportunities and risks right now.
Opportunities. Well, the motorcycle business is clearly a huge strength. Financial services provide stability and growth. Their heavy R&D investment is an opportunity for future leadership, if executed well. And, improving quality control could yield benefits. Plus, they have a strong balance sheet.
And the risks.
The risks are stark. Those massive potential impacts from tariffs and currency are number 1 and 2. Then there's the ongoing pressure on profitability in the core automobile business. Rising R&D costs are a constant drain until they pay off. And, there's always a background risk of further costs related to things like the ongoing airbag recalls.
Okay, so a real mix. FY25 showed resilience in parts of the business, but also significant vulnerabilities. FY26 looks set to be a year where they navigate some serious external storms while continuing to invest for the longer term.
Precisely. How they manage these headwinds, particularly in the auto segment, while leveraging the strength in motorcycles and finance and making those R&D bets pay off, that will be key.
It certainly sets the stage for an interesting year ahead. Thanks for breaking all that down for us.
My pleasure.
It really makes you think. Considering these results and the headwinds they're forecasting, what are the big strategic choices or pivots Honda might need to make now? How do they ensure that long-term profitability in this incredibly fast-changing auto world? Something for you, the listener, to ponder.
Definitely food for thought.
And thank you for joining us for this deep dive into Honda's FY 2025 financials. We really hope you found it insightful. Don't forget to like, subscribe, and share if you did. We'll catch you next time on Stock Talk.